Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Sean Kiernan, CEO of Greengage, a merchant bank for the age of cryptocurrency, whose strategy is both narrow and broad. The narrow mission is to take deposits from holders of cryptocurrency and lend to small and medium-sized enterprises. The broad mission is to build a bridge from the emerging world of cryptocurrencies and blockchain to the world of traditional finance. Sean, thanks for joining us.
Thanks for having me, Dominic.
Now, take the narrow mission first. Lending against cryptocurrency collateral is a pretty well-established market now. We've got bank-like deposit takers issuing loans. We've got peer-to-peer lending taking place via DeFi protocols. What exactly do you plan to bring to the market? You mentioned in our earlier discussions, taking fiat currency deposits from cryptocurrency exchanges, making fiat currency loans to SMEs. How is all that going to work? What are you bringing?
So I think the core mission is to get a banking license, and the banking license is focused on the fiat side, so the pound sterling, dollar, euro, of the crypto market. And we see there's still a very strong gap in the crypto market for a fit-for-purpose bank to hold fiat deposits for crypto companies. We see in the US, in Switzerland, and a few other countries, there are several banks that serve the space. In the UK, there are none that are actively offering accounts in pound sterling primarily to crypto companies. And we think that is something the country needs. There are a few firms thankfully offering e-money license services for payments. But on the whole, the risk-weighted assets that a bank can offer for a firm that's looking to place funds are very attractive. And as a business, we've seen quite a few challenger banks set up focused more on the payment side of the business perhaps initially, and then pivot towards lending. And lending, I think, for a bank is the bread and butter of where they make money. And so our focus is to lend those deposits to a sector we think is also underserved. In addition to crypto companies, we think SMEs don't necessarily get the lending that they need from the existing banks in the UK.
Now, you mentioned the banking license. You've obviously been operating for 2 or 3 years now without a banking license, and I think your role has been as an introducing broker. So what have you been able to achieve within those constraints, not having a banking license?
Well, it's been interesting. I think out of challenges comes innovation, and we needed to achieve some revenues in order to survive as a business. As a startup, I think revenues are king. And for us, the focus then was what can we deliver for our anticipated client base that added value to them, built relationships with them, such that when we have a banking license, we can prove that we've already onboarded clients and have done business and they trust us. And we did see a gap in the market. I think we are still one of the very few players to be effectively an introducing broker for lending against crypto at wholesale. So we don't touch retail. That's not our focus at all. But we have a very good group of clients that we can help facilitate loans for their long crypto positions into fiat using partners. And here we work with family offices and private equity houses to deliver those loans.
Now, you mentioned risk weightings. Won't a banking license impose risk-weighted capital allocations on you? Won't that make it much harder for you to compete with these other lending institutions, which we mentioned at the outset?
Very much so. And we've seen with the Basel Committee of Banking Supervision, the risk-weighted assets that a bank would have if they held crypto on the balance sheet are effectively 100% that you need to hold on your book to countenance that crypto assets could fall to zero. That's the view of the Basel Committee. In practice, as a bank, it effectively makes it punitively too expensive to hold crypto on your balance sheet, meaning for a bank, it's very difficult to lend on its own books against crypto assets in fiat. This has shifted, as you've rightly outlined in the introduction, the lending markets away from banks offering loans, rather to other platforms, including DeFi or CeFi, fit-for-purpose platforms that are lending against crypto, Celsius, BlockFi, Genesis, to name a few. As a bank, and why I think the title merchant banking is so key for us, we definitely intend to continue to work with third-party balance sheet partners as we do today, meaning that the business we facilitate today with third parties is something we intend to continue. We would be watching very closely the BCBS guidelines, and we think they might soften as the market matures and perhaps the risk weighting isn't so punitive, that perhaps a bank could hold crypto on its balance sheet in future, but for the time being, we do not plan to do so ourselves.
Right. So to be absolutely clear, from the outset, you're not going to be taking cryptocurrency deposits. You're going to be taking fiat currency deposits only, right?
Well, custody is a different thing to taking deposits, and that can be held in a different vehicle, perhaps in a different structure. But we wouldn't be able to offer loans against crypto on our books, because that would mean effectively our capital requirements would go through the roof, and we're looking to make a profit.
Yeah, no, I meant deposits, not the custody, but we'll come back to the custody thing.
Yeah.
Can we talk a little, before we do that, can we talk a little bit about the type of clients who are looking to recruit? Now, on the lending side, the asset side of the balance sheet, if you like, you're aiming at SMEs. How familiar are those SMEs with the world of cryptocurrency and blockchain? Are you finding SMEs actually holding the asset or not?
No, I mean, I think this is very early days for most SMEs. There are some, however, that are very au fait with it. And I hear I reference quite a few tech-focused firms. Many of the founders of tech firms hold crypto in their private capacity, and by consequence, some of the businesses are more familiar with it. But a bread and butter SME is not really ready for crypto just yet. This is a fairly innovative thing, and still speculative on one level. What we do think there are reasons for the two to merge. I think one, there is increasingly, it seems, an interest to pay for services in crypto, and there are platforms that facilitate that today. And the second is, I think, for us, the bridge between the crypto world and the SME world will be what we see as a digital debt market emerging, meaning that SMEs can raise capital in sums that they cannot raise from banks necessarily, given the restrictions that banks have for risk-weighted assets on multiple levels and concentration risks. But we do think that SMEs need funding, and to get bigger sources of funding, we think digital debt could be an answer, basically a digital bond.
Now, the liability side of the balance sheet, you've mentioned that you're looking to take deposits from cryptocurrency exchanges who tend to hold quite a lot of fiat currency themselves. Are you aiming to recruit any other type of depositors, or are they your initial and medium-term focus, the cryptocurrency exchanges?
They're definitely the biggest holders of fiat for a crypto-focused bank. The exchanges, by and large, hold considerable amounts of fiat currency, as their clients are often looking to exchange between fiat and crypto on their platforms, and that fiat needs to be held securely. In addition to exchanges, which are the biggest client base, and here we very kindly had the Silvergate IPO filings, which gave full disclosure on their breakdown of client base. Exchanges are roughly, I would say, a half of the attainable market for fiat deposits in the crypto space currently. But there's a whole suite of other firms in financial services, in the tech space. Crypto miners, for example, have long positions because they need to also pay salaries and electricity in fiat currencies as opposed to crypto. So there is quite a broad industry, which I think we'll cover later. The UK also features quite a few firms across the board. And it's not just financial services or exchanges, it's also tech and increasingly other use cases for blockchain. These still give pause to some of the banks that would potentially bank crypto companies or blockchain companies, largely because I think of AML concerns, but we can cover that, why I think there are probably fewer AML concerns if you know what you're doing.
Right. Let's talk a bit about your competitive position in this market. Let's look forward to a time when you've got your banking license. How distinctive is that going to make you in terms of, you've already described that it makes it more difficult to compete, but in terms of your standing, particularly among institutional investors, in terms of the services you can offer, is having that banking license going to make you very distinctive within the field of cryptocurrency deposit taking and lending?
I mean, I've had to think about this quite a lot. We've been looking to work with regulators to get a banking license for some time. And a banking license is a binary. It's a yes or a no, and it's not easy to get, nor should it be easy to get. And I think eventually, should we be so lucky to receive one at some point in the future. It is definitely a defensive position because you have gone through the long path to receive one. But it's not the end of the road. Ultimately, a firm in any space wins by service and looking after clients and the products that it can offer and the relationships that it can introduce and work with. And I think for us, the key thing will be to create a platform business that can help to offer long-term value to clients and also treat them with respect.
Now, in the cryptocurrency lending world, the lending is collateralized. And what sort of haircuts are we seeing on collateral, cryptocurrency collateral posted against fiat currency loans?
Something that I've been fascinated by is the rise of even uncollateralized lending. We've seen that in DeFi. There's a few protocols which you can arrange a loan without having anything posted. This, to me, I mean, I'm sure there's use cases and rationales for it, but it's not what we do. I'm perhaps more of the old school variety. Like collateral is a good thing, just in case. And I think the rates that you can see in the collateralized space from proper institutional houses still are getting quite attractive. These can reach anywhere from, say, 50 to 70%, and there are variations on a theme of posting, say, Bitcoin to receive fiat, meaning that you could get for every Bitcoin 50 cents on a dollar, or more if you're looking for a loan. And that is, considering the volatility of the asset, quite an interesting development.
Well, so it's a lot heftier than you'd get in the securities markets. Now, you mentioned the difference between deposits and custody a minute ago. Now, insofar as cryptocurrency is going to be posted as collateral, are you going to do the custody in-house, either before or after you get the banking license, or are you planning to work with, or do you work with some specialist custody provider?
I mean, the idea is to work with partners. I think if we look at the traditional financial services world as a benchmark, the world of custody is distinct from the world of banking. There are third parties that have a significant amount of capital and presence in the market, and we feel comfortable with that approach. There are platforms that offer everything under the same roof, and maybe that will be the way the market moves. But for us, we prefer to look to the traditional world, time-tested patterns of distinct fiduciary responsibility at different stages, custody, trading, etc. And we think that offers value for our clients ultimately, and that they can be sure that if we went bust or any step of the value chain went bust, there were also approaches to offer surety for them that their monies were secure. And
as we all know, 80% of the cryptocurrency market is basically Bitcoin and Ether. Are you, as you look at the marketplace, are you seeing the collateral similarly concentrated in a very narrow range of cryptocurrencies? In other words, are some cryptocurrencies more eligible as collateral than others?
I mean, speaking of us specifically, those are the only two we've ever interacted with in terms of our introducing broker business. We've done now several hundred million of volume on those two underlying collaterals. But they're not exclusive. We've seen quite a few others, particularly in the DeFi world, emerge that are quite varied. I would say at this stage, that's not for us. We're looking at the biggest and most liquid, because we think that's probably the best in a downturn scenario that you could exit if push came to shove.
Yeah. And how sophisticated is the collateral management services that applied to these postings getting? Is a kind of margin call system developed? In other words, more collateral is called for when its value falls, and maybe if its value rises, more credit can be advanced. Are we seeing that type of thing happening in the marketplace?
Very much so. And we're seeing the full suite of, I would say, relatively sophisticated products emerging. Margin calls, if there is a collateralized loan, are a feature by definition. Some houses are offering what we call systematic margin calls. And in some of the flash crashes, which crypto can have occasionally up or down, there have been features where some of those margin calls have not been received very well by the borrowers particularly, because they've seen that their collateral wipes out and then bounces back quite quickly, at which point that they've had to close their trade. What we've seen increasingly is that there have been approaches to look to moderate that impact, either through the use of hedges or more sophisticated trading strategies, where you don't necessarily need to have a hard margin call quickly for a client. And it seems clients are responding to that in the market.
I assume as the volatility decreases, that problem kind of goes away, doesn't it? Are you seeing any conventional forms? We've talked a lot about collateralization. You've mentioned that some of the lending is not even collateralized at all. But is any form of conventional credit assessment going on? Are people running? And I think the UK government has insisted this is done. People running know your client, AML, CFT, sanction screening checks as well. To what extent are people really assessing their counterparts?
So by rule, any firm in this space falls under the crypto MLR registration regime by the FCA if they are operating in the UK. And so we're on currently the temporary register and hopefully soon the permanent one, subject to approval. So in all cases, we run checks, and we would in any case because of our backgrounds. We're very kind of old school again in that sense. But in terms of credit analysis on the counterparty, this is an interesting question because that currently doesn't fall within scope of the crypto MLR, which is currently very focused on money laundering checks and potential risks there. We've taken the decision not to touch retail because we think there are risks around lending to retail clients, which are significant. And I think for us, the B2B lending market is probably more of a secure platform, knowing that the counterparties know the risks that they're going into typically. But in terms of credit checks, I think that is something that should feature, particularly if retail clients were to be brought in and have that be within the regulatory perimeter, that they know what they're getting into, at least by disclaimers, which I hope they are used in most cases, if not necessarily in DeFi, where there's nobody to give disclaimers, perhaps.
You're going to need to manage the liability side of your balance sheet as well as the asset side. How do you go about assessing the risk represented by a crypto exchange as a lender to your bank? What do they pose novel types of risks in terms of credit and reputation, or are they actually quite familiar?
Well, I think thankfully the space is growing up. Most of the exchanges are regulated. Most are having treasury management teams. They're having risk management teams, and I think the level of sophistication actually helps as the years go past to make that less of a risk for a firm looking at banking these clients. However, our ICAP, or the way that we've looked at developing a capital adequacy for the bank, has been quite varied and stress test on many levels because of the unique natures of you mentioned reputational risk, but from one day to the next, one firm that you think you knew might have fallen foul of a regulator in a different jurisdiction. But I think that is something, again, that we're not alone in having to have done. There are quite a few firms that have banked sectors that are new or up and coming. And I think the way you take care of that is just by allocating perhaps higher capital to such businesses and maybe doing less risky lending or less longer term lending in case you need to match the liabilities and assets on the balance sheet.
Talking of the assets, as you look at the market as it is now, what sort of terms are being achieved? What's the duration of these loans? What sort of size are we seeing? What amounts are being achieved? And is it your intention to extend the terms and increase the amounts because you're operating in a non-retail space? So how's the market now in terms of duration and size, and what do you expect it to be once you've got your banking license and doing things differently?
So to give you a feel, one, I'd like to caveat that we're only looking at long-term ourselves. We see that to be a niche in the market that we add value for. If we are looking at shorter duration, which I think is the majority of the market, a firm like us wouldn't really add value. There are solutions that you can find relatively quickly. We found a specialist niche for long-term loans. And here we've added not just lending against crypto, but lending to crypto miners based on the asset that they have, as in the data chips, etc. And we found partners to deliver those solutions. But the overall market, and this is just a figure, is that DeFi has locked in contract well over 200 billion, which emerged, I mean, even last year it was a fraction of that. I think it was 10 billion at the start. And crypto lending on CeFi platforms, just one firm, Celsius, now has 30 billion under management on its books in terms of lending. But that again is quite a huge degree of growth in the time that we've seen. Just in 2 years, this was again a fraction of that. The majority is shorter duration, if not kind of less than a month. But we've looked at perhaps the precious metals market as the closest comparison we can see to what's emerging. And one of the most developed precious metals markets is that in India. And the long-term duration at max, in terms of 1 year plus, is perhaps 5% of the total exposure of loans originated at max. And so we think that that's still a big enough space and an interesting enough space for us to focus on, if that's any benchmark.
Yeah, I'd like to come back to that metals market in a second, but just before I do, your definition of long term is what? More than a year?
Yeah, 1 year plus.
Okay. Now you brought up the lending against precious metals. You mentioned India. Do you see that as a market which you, in effect, will overtake? Is it complementary to you, or is it something, just a kind of analogy for you?
I think there are very few analogies out there. So we have tried to look for what else in the world can be something to give us an indication of where the market could shape towards being. Crypto is new by many definitions, and what it allows is also quite innovative. But it also indicates what people have been wanting to trade and do for millennia, which is to look to get value from something and to exchange value. Precious metals, I think, and this is a broader answer to your question, but quite an interesting market as a comparison. The value of silver, for example, is actually less now than the overall value of crypto assets, which is a bit shocking. It's still less than gold. Gold is a bigger asset class. But crypto, with a valuation of over 2 trillion, has surpassed some of, let's say, precious metals that have been around for as long as humanity's been looking to store shiny things that are rare. Mm-hmm. And so I think we've tried to look at, and I think people have always likened Bitcoin to digital gold. But crypto behaves very differently on many levels. And for us, being focused initially on this lending side, we do see people holding crypto as a store of value, for better or worse. But they are looking to leverage that then to achieve other goals, because they're looking to hold the underlying and still get liquidity for whatever they need day to day.
Now, I don't know how that lending against precious metals market in India is regulated, but you must have a pretty clear idea now of the regulatory treatment of lending against cryptocurrency in the current environment, but also once you've got your banking license, how it will be treated then. In other words, once you've got your banking license, presumably those deposits are going to come inside the ambit of the banking insurance scheme. So if you fell over as a bank, the depositors would be protected up to a certain level. Is that how it's going to work? And there's no protection at all now? Is that a reasonable summary? Nothing now, but conventional deposit protection once you've got a license?
So on the fiat side, it would be fully standard, and the bank would be fully fiat. We do not intend, and just to be very clear, to lend against crypto on our own balance sheet. I think that we will continue to work with third-party partners as a service to introduce, but with ideally regulated partners to the extent we can. I think there are broader questions again around the existing platforms that are offering lending services against crypto, particularly for retail consumers. And we have noticed increasingly that regulatory interactions have been focusing on several of these businesses to raise questions. And there have been, at least in the States, some indications around cease and desist orders that we're watching very closely, which might be a direction of travel, and hopefully in the end will result in better protections for consumers. And some of these businesses perhaps will become more bank-like, needing regulatory capital, some of the mechanisms that banks are deploying to manage their credit risk exposures at scale. Mm-hmm.
I'm concerned I'm not understanding something here. So this cryptocurrency, which is, say, held in custody with a third-party specialist provider, is that eligible as collateral you're not holding it on your own balance sheet, but it is a form of collateral which people could advance to borrow fiat currency from you. So you're taking in fiat currency deposits, you're making fiat currency loans, but a form of collateral might be these assets held with third-party custodians. Have I misunderstood what you're doing there?
Not at all. So that is exactly what we're doing today, but it's not on our balance sheet, and it never will as a bank, because to do such activities on a banking balance sheet, on your own books and records, is punitively expensive with the BCBS risk weighting, meaning that what we do today is what we will continue to do in future, which is introduce to third-party balance sheets that are able to take that collateral and lend fiat against it. And that's something that I think is a very good business on a wholesale level, and what we continue to do to achieve profits, hopefully, and good relationships.
What are the borrowers using this money for? And I suppose I have the impression that a high proportion of the borrowing currently taking place in cryptocurrency borrowing and lending and DeFi as well, it's being used to support trading activity. And therefore, it's a bit like, I don't know, the securities borrowing and lending market, where trading firms are borrowing the asset to cover a short position they have or to upgrade collateral. But maybe I'm misunderstanding that. Maybe this isn't just the borrowing isn't driven by trading activity. Maybe there's a broader range of uses that it's put to. And how's that going to change once you've got your business up and running and lending to SMEs?
So I would suggest that there are probably very different reasons for retail borrowers, again, which we do not touch, and wholesale borrowers. But I think there is definitely a large proportion of wholesale borrowers which are using the loan monies to conduct trading activities and leveraging up and covering positions. But there's also quite a few of them that are using it to build their book of business. They have, particularly for those firms that have been there from the beginning, they have the view that crypto assets will increase in value considerably. And for them, then it's proper treasury management that they see the asset increasing. They do not want to sell, but they might need working capital to pay for treasury, to pay for salaries or office space. And in that context, that makes sense for them. Retail consumers, we've seen quite a few people make a lot of money in crypto. They might have a similar ethos in that they think it's always going up. They might take a loan perhaps to buy a house or to buy something that they've not envisaged that they could afford. And the beauty of most of the lending products is actually that they're non-recourse, typically, meaning that it's effectively a hedge on the collateral, in that if there is a margin call, God forbid, you can walk away with the fiat that you've received from the loan without any strings attached, if that is the construct of the loan that you've taken out. And in the case that you get 50 or 70% fiat against the collateral that you've put up for the loan, and the collateral drops whatever percent it may be beyond that, you at least have then a protection level that you've been able to extract value at X amount, and keep that. And so I think that's another reason why some people are looking at this as not necessarily a play to leverage up or take more risk, but to de-risk.
So you could foresee retail borrowers at least being comfortable borrowing cryptocurrency, but having their asset denominated in fiat currency. So they're happy to take the risk. But you can't imagine that happening in the institutional market. Is that right?
I wouldn't position it that way. And apologies if I led to convey that as an impression. I think the retail world, I have a very strong respect for people in the space, but it's not for us. And I think the risks in that space are quite large for a retail consumer taking a loan. But I think institutional borrowers know what they're doing. By definition, they're institutions that have ideally the financial acumen to understand the risks. And in that case, lending isn't always an increase of risk for them. It could be a de-risking exercise for the reason I mentioned.
Mm-hmm. You brought this up earlier. You look forward to a time maybe when companies are kind of issuing long-term debt. Now, did you have in mind there that these would just be longer-term loans, or did you imagine them being conventional securities, bonds, if you like, or maybe even security tokens? What did you have in mind when you were talking about long-term instruments?
Well, I mean, as it stands, in the current iteration of what could be possible, these would have to fall under the traditional bond type regimes for issuing of debt, and it could be a security token. Most evidently, there are firms working on this across the whole suite of product, but I haven't seen many banks look at this as a source of perhaps raising monies for companies that are their clients. And the beauty for us as a startup firm with a limited balance sheet, at least initially, is that we think this could be an extension of our balance sheet using the capital markets to deliver value and funding to clients. And the capital markets are looking for interesting products as long as it can be packaged in the right way. And so we think there would be offtake. But I think the real gap in the market, perhaps, we have noticed that crowdfunding has come along quite a bit. And the size that these peer-to-peer platforms can raise, typically, for whatever reason, maxes out at around 100K on average for a borrower. And the type of bond markets, just given the costs of creating a bond, being in the hundreds of thousands, pushes the size that bonds are typically raised at to be, say, 50 million plus, although there are smaller bonds. I don't want to prejudice that. But between that, say, 100K to the 50 million roughly, and these are very rough, there's a gap in the market that banks historically have filled with their own lending activities. Credit funds are now increasingly playing a role in lending to I would say, the smaller size businesses that need less than 50 million. Mm-hmm. But we do think there could be a space perhaps for a lighter prospectus regime or perhaps less onerous requirements than some of the bigger bond issuances require for SMEs. And that would be the market that we would love to be part of a dialogue as this emerges in the coming years. But for now, we very clearly will follow existing guidelines if we are to progress in this space.
Yeah. Now, I'd expect you to find it, like most lenders, a lot easier to find borrowers than to find lenders or investors. You've just described a sweet spot. You think you can occupy somewhere between the 100,000 for crowdfunding and the, say, 1 million for smaller bank loans. Is that where you're expecting to, if you like, supplement the cryptocurrency exchange deposits? That's where you're going to find your investors or depositors, is in that area between 100 and 1 million. Would that be right, or are there other groups you think you can appeal to?
We think that is very much a gap in the market, and for a startup bank, it's a very good space to operate in because the sizes aren't too large that if any one of them went sour, we would be able to recover at least other loans on the balance sheet. In the long run, I think the size of those could increase with the likes of digital debt products, but that would not be something we issue in the short term. You need to gradually walk before you can run.
Have you thought about issuing a stable coin as a way to raise deposits?
It's an interesting question. Stable coins are very in vogue at the moment, and we've seen the Bank of England consultation on CBDCs, for example. Stable coins, to me, seem to be, at least in the direction of travel we're hearing from the market, seem to be something that fits very well with the commercial bank, as in a bank has the level of capital and trust and regulation that it could hold stablecoin assets very well. JP Morgan, for example, launched the JP Morgan coin that's been used in pilots with Goldman Sachs to exchange value. The question for a firm like us is if that makes sense for a startup bank to operate in. And initially, I don't think it does. I think we would have to be a bit bigger before we had the heft and materiality for that to be meaningful for a client. But it's not something I would rule out entirely.
Yeah, it'll take you a while to get as big as JP Morgan, I think. Now, you mentioned CBDCs. Do you think they'd be good for what you're planning to do, or bad, or make no difference?
I think they're great, to be frank. I think we've seen in the likes of China what's happened with digitized payment rails and the frictional cost reduction that can achieve for making speedier movement of monies for a whole host of clients, and particularly for cross-border transactions. I mean, that time that it takes for monies to settle when you try to pay someone international is quite long. and reducing risk by making that quicker would be very much a benefit. I think the question will be how they're deployed, and which is what people are asking at much bigger pay grades than I am. How can a CBDC be rolled out? And again, this distinction between retail and institutional, I think, is very important, because ultimately, I cannot see a world where it makes sense for retail consumers to hold deposits directly with the central bank, because that would effectively dry the well of commercial banks and their need for those deposits to engage in lending activities. So I think for a firm like us, we're very closely watching, but it's something that I think would be great in terms of digitizing payment rails and increasing efficiencies. But there are some questions around at what level will these be rolled out, with whom, by whom, and how will they be monitored, that I think are being worked out as we speak.
Now, something different. You recently supported a comprehensive review of blockchain investment activities in the United Kingdom. You published a report, a very interesting report, and that found the majority of the investments into blockchain in the UK have been going into fintech. 17% of the investments gone there, crypto trading 14%, and then a bit more if you add in crypto finance companies. What does that tell us? Does that tell us that the British economy is over financialized, or is just the way our economy is structured, or does it tell us something more interesting, more intriguing than that?
So this was a very big report for us. We worked on it with the Big Innovation Centre, Deep Knowledge Ventures, or Deep Knowledge Analytics, and Greengage was looking to refresh a report we did with the same group 3 years ago, which chronicled that the UK could be an epicenter of blockchain innovation, which we still think is very much on the cards. The real question for us is, as you've outlined, is this a financial services game, or is this something where blockchain can be used for identity or storage of data in a whole host of industries? I think the figures we've seen in the UK, and I can't speak to hard numbers, but anecdotally, seem to be what we've seen in other countries as well, in terms of where the money is going into crypto or blockchain as an underlying technology, is predominantly in financial services. And perhaps that's because financial services is such a big part of the UK GDP, but it's part of quite a few Western economies' GDP at a large scale. London is an interesting place, in that it is an epicenter both of finance and technology, which is very few cities globally. And it does seem then a natural fit for an industry like this to emerge here. But I do think that there needs to be more of a proactive industrial strategy to really capture the potential of what has emerged, and to allow companies to grow in a competitive but still supportive environment.
Now, something else the report mentioned was the growing institutionalization of cryptocurrency investing. It cited Ruffer and Brevin Howard, who are the usual firms put forward as pioneers in this area. But I was very surprised to see a figure of 53 cryptocurrency funds being available in the UK, partly because I thought the FCA had banned that, but perhaps I'm misunderstanding what was being referred to there. But anyway, are you seeing this institutionalization coming through in your own business now, and do you expect it to come through very strongly once you've got your banking license and are fully underway?
So I think the trend is definitely, the institutional space is very well aware of what's happening. The question is in what capacity? In terms of financial services, we've seen the biggest names go into stablecoins or custody services initially. These are probably the most straightforward for them to roll out initially. But to actually hold positions in tokens or crypto assets, or to trade them, is something else. And we've seen some exchanges emerge which are regulated by the FCA, and some additional players that are looking to set up investment positions. But we haven't seen the big deployment of the biggest institutional investors, i.e. pension funds and insurance companies, actively placing monies in crypto. The players that have engaged have either looked at this, and this is a very broad brush stroke, so don't quote me on it as such, but have engaged either because the principals of the firms might have an intellectual interest in the space or a private position which they then have built an understanding of it, or they look at it as a hedge against inflation. which with quantitative easing, people are looking at options as inflation is now here to diversify.
Yeah, inflation here heading for 5%. I saw the banks saying on Friday. Something else this report implied and occasionally stated quite explicitly was a concern that regulation in the UK is falling behind both so-called offshore jurisdictions like Gibraltar and Liechtenstein, but even the United States, despite the fact that the United Kingdom is no longer part of the European Union. So Brexit's created room to make up your own regulations, and a more helpful approach could be adopted. There isn't much sign of that. We've had this FCA guidance, what's inside their regulatory perimeter, what's outside it, and cryptocurrency is very much outside it. We've been told that, as you mentioned earlier, we've got to run KYC, AML, CFC sanction screening checks. And the Treasury's got this consultation going now on cryptocurrencies and stable coins, and the Bank of England's involved in that. But what do you think needs to be done in order to make the United Kingdom a more appealing place for blockchain-based financial services? And I'm thinking particularly of DeFi, how DeFi should be regulated. Do you have clear ideas in your own mind about that?
Well, this is it's quite a big question again. I think at the biggest level, we have to ask why did Coinbase, which is probably the highest valuation company in the space, set up in the US, and where is the biggest UK company with all the natural advantages that the UK has in terms of proper governance, good regulation, the rule of law, and as I mentioned, London being centre of finance and technology. I think the danger in this space is it moves so quickly. I mean, no one had seen DeFi coming at the scale that it came so quickly. NFTs, I think, I hadn't heard of. I've been in this space for a very long time, relative to some others, until they'd arrived. And I think one of the things for regulators to just take account of is that there is an industry here that is very willing to work in knowledge sharing and raising awareness of things. I think the best asset that any country has is to use the skills that it has within its disposal, and also show willing. There are lots of inherent risks in many things, including in the space that I operate in. But we are trying to do things the right way, to work, as you've outlined very kindly in the beginning, to bring the traditional financial services space to the world of crypto and to do it responsibly. And I think for us, this is a long-term game. So we're not keen on making a quick buck at all. This is building the roots to look at changing what could be the plumbing of the financial services system entirely, if it is digitized, and then rolling out additional innovative solutions that are better for consumers on top of that. How that happens will require regulatory collaboration, but also a certain degree of freedom to allow firms to innovate, working with regulators, but without having necessarily an environment where regulation is stifled, or where innovation is stifled. Apologies.
Mm-hmm. Striking that balance between freedom and restraint, I suppose, is what effective regulation is all about. One of the other points the report makes is that some of the most, whatever's going on the regulatory side, some of the most prominent DeFi projects are actually based here in the United Kingdom. And in a way, whether you like it or not, you're going to be part of that market. Do you ever worry that the market, some of the things you see happening in DeFi, lending and staking, like people effectively moving deposits around every 15 minutes in pursuit of a higher yield, so you get this constant switching going on. Do you ever worry that developments like that could make running a licensed bank like the one you have in mind very unstable? Your deposit base becomes, if you like, an unstable part of your structure. Do you worry about that or not?
So we don't do anything in DeFi, and I want to caveat everything I say subsequently by making that very clear. And there's a whole host of reasons we don't engage in DeFi today, and I think primarily it's because of the AML and KYC.
I meant, Sean, you're part of this evolving universe, I suppose. And it wasn't just you're in it today, but I'm thinking that as the market evolves, you're going to be drawn into it. Am I wrong about that as well?
And again, my second caveat is we would love to be part of it. And we actually wrote a white paper not too long ago, which is on our website, exploring some of the questions around how a firm like us, who is trying to do the right thing, could engage in DeFi and still hold its head high. DeFi is a fascinating development, and in a way, it flips the head on how does crowdfunding work, and brings it that peer-to-peer ideology into a much broader sense. And yet, it still is movements of money. It still has the need for what we think is fiduciary responsibility along the movement of money between actors. And as it stands today, there are deep concerns we have around, if you do not know the other leg of a trade, how could you engage in a financial transaction as a regulated firm without the capacity to run KYC or AML checks? And there are solutions to this emerging. There are concepts like, say, a walled garden, where there are firms that have been, or individuals or actors, that have been fully vetted, just trading amongst themselves. You can have blacklists or whitelists of bona fide or not necessarily bona fide actors which are prevented from engaging with things. But again, the reason I think I was keen on CBDCs, and why I think that could be a positive for a central bank or a country to explore, is the capacity for efficiencies. If you can reduce the frictional cost of trading or exchanging or finding somebody to do business with in a proper context, that can allow then for more frequent transactions. And to your question on if that's a challenge for a bank to have clients that trade all the time and move deposits very quickly, I think it would be. But I think you could rise to that. You could rise to that challenge, and I think banks will have to rise to that challenge. I think long-term sticky deposits are fantastic, and everyone will fight for them. But if there are ways to have a really sophisticated treasury management system and use the new technologies to monitor flows of funds, I think there is a way to do this as a proper business, and I think that will emerge in time, and that's why we're keen to follow it.
One final question, Sean. If you take the view as I do that cryptocurrencies, DeFi, CBDCs, tokenization, so these are all points on a spectrum, and that one day these innovations which are coming out of the cryptocurrency and DeFi and tokenization worlds are going to spill over that bridge which you're building between the traditional financial world and the financial world which is emerging through those innovations and experiments. Do you think that some kind of balance eventually is going to have to be struck between traditional deposit taking and lending style banking, between centralized banks and clients at one remove, and this sort of DeFi world of decentralized, self-executing, peer-to-peer protocols? Do you have an idea yet, as you look 5, 10, 15 years ahead, where you think that balance might be struck? Because I hear everything you said about not being involved in DeFi and how you think it's fascinating and so on, but and you're going to be part of this evolution going forward. You want to be part of it. You want to build those bridges. Where do you think that balance is going to be struck? Where's it going to be found?
I think it's very dangerous to have a crystal ball, and so I can only speak in terms of principles. But I do think there will be projects, and I think regulators are looking at this, having it be deemed a systemic risk. Not too long ago, that DeFi will change, and in some capacity will be brought within the regulatory perimeter. And I don't see that as a bad thing. I think setting principles for conduct are a very good thing to give trust and to allow people to engage at scale. I think when that happens, and that will be a matter of years, I don't think this is going to come quickly. We could see then institutional monies come in at a level that have not yet happened, if there are the right players to offer solutions, good practice, and ultimately insurance and capacity to make good if transactions are hacked, or if there's some issue with the counterparty. When that happens, I'm going to repeat the mention I made of the plumbing of financial services. We're still operating on fairly old school plumbing, in the sense that some transactions are still being handled by paper, and there are still many actors along the value chain of financial services that have what could be deemed a rent or a certain role that perhaps doesn't need to be there if a digitized value chain emerges. I don't know how that's going to take place, and I don't know which actors will evolve and which will adopt the new technologies. But I do see it as inevitable in the sense that the fintech revolution that's happened largely in the front end of financial services will happen in the core. And when that happens, I think traditional banks will need to adapt. And that's what we hope to be part of the story of.
Sean Kiernan, thanks very much.